So we live in a world where, almost every major industry has been completely swallowed up, just digested and centralized by technology.
Right. It's all digital now.
Exactly. I mean, if you want to ride somewhere, you don't call a local taxi dispatcher anymore.
No, you just open an app.
Yeah, you open an app that algorithmically connects you to this, global network of drivers in milliseconds. Or if you need to buy something.
You're definitely not browsing a specialty catalog.
Right. You don't walk into a department store. You just go to a centralized giant like Amazon.
Yeah.
We've basically spent the last 2 decades optimizing the entire physical world for this friction-free, borderless digital access.
It is, without a doubt, the defining economic shift of our lifetime. I mean, it's the consolidation of these fragmented local markets into global digital monopolies.
Yeah.
We just expect the entire world's inventory to be, right there in our pockets, instantly, and usually with free shipping.
Which is exactly why the global lottery sector is such a staggering anomaly, because we are looking at an industry valued at roughly $380 billion annually.
Which is a massive, massive number.
It's a behemoth. I mean, that easily dwarfs the global box office, the music industry, and major sports leagues combined.
Yeah, combined, it's huge.
And yet somehow, despite all of our technological advancements, this $380 billion giant remains almost entirely analog.
Right.
We're talking like 95% offline. In an era where you can do one-click crypto purchases or, algorithmic high-frequency trading, people are still literally walking into a physical convenience store.
Standing in a physical line.
Yes, standing in line, handing over physical cash just to get a little printed slip of paper.
It is a profound structural inefficiency. I mean, think about it. This enormous, globally recognized product. It's perhaps the most universally understood game of chance in human history, right?
Oh, absolutely.
But its distribution network is essentially frozen in the 1990s. The infrastructure relies entirely on foot traffic. It relies on local retail geography.
Well, today, for this deep dive, we are examining a highly ambitious, highly specific project called PlayLottoGlobal, or PLG for short.
Yeah, PLG.
And their entire stated mission is to forcefully digitize this $380 billion fragmented giant.
Which is no small feat.
Not at all. And what's really fascinating here is that we aren't just looking at, their public-facing website. That would be interesting enough.
But we have the real stuff.
We do. We have a confidential strategic growth framework document. We have their internal financial projections. And honestly, this is the most interesting part. A raw, unfiltered transcript of a pitch meeting.
Yeah, that transcript is pure gold.
It really is. It's a recorded conversation between Todd, who is the founder of PLG, Howard, the president, and an investor named Jeffrey. And Jeffrey, he has deep ties in Forex trading, global satellite agencies, and these massive media buyout networks.
That transcript, it's essentially a masterclass in modern business strategy and high-stakes negotiation. You are getting a real-time, unpolished view into how global market capture is engineered behind closed doors.
Right.
It exposes everything. The regulatory maneuvering, the highly engineered economics of decentralized affiliate marketing, and the specific psychological tactics they use to convince a Wall Street-minded investor. Not just to provide capital, but to weaponize their entire existing network.
Yeah, weaponize is the perfect word there. But before we get into the complex web of QR codes and Wall Street funding structures, I think we have to establish exactly what PlayLottoGlobal is selling to the world.
Right. Let's start with the product.
If you look at the consumer-facing side of their platform, they are offering access to 18 different international lotteries, available 24 hours a day, 7 days a week.
And we should clarify, they aren't dealing in small, regional, daily draws.
Yeah.
They're listing the absolute titans of the global lottery world.
The heavy hitters.
Exactly. They are aggregating the largest liquid pools of capital in the gaming sector. We are talking about the Mega Millions, which at the time of these documents was sitting at a 215 million euro jackpot.
Wow.
Superenalotto in Italy at 165 million, the Eurojackpot at 118 million, and then you have El Gordo and La Primitiva from Spain, the UK National Lottery, Lotto France, Mega Sena from Brazil, and the Australian Powerball.
Okay, so seeing that list immediately raises a massive red flag for me regarding compliance.
Oh, of course.
Because cross-border gambling is notoriously one of the most heavily scrutinized, legally treacherous industries on the planet. I mean, governments fiercely protect their state-run lotteries.
Because they are massive sources of tax revenue.
Right. So how does a single startup legally offer the Italian Superenalotto to a guy sitting in Brazil while also selling the U.S. Powerball to someone in Germany?
Well, they achieve this through a highly deliberate, multi-jurisdictional corporate architecture. I mean, it is essentially regulatory arbitrage. If you trace their footprint, the platform itself is operated by a company based in Wyoming.
Okay, wait. Wyoming? Not exactly the gambling capital of the world. Why Wyoming?
Taxes and privacy. Wyoming offers some of the strongest corporate privacy and limited liability protections in the United States,
Ah, okay.
alongside very favorable tax treatments for digital assets and LLCs, so it shields the parent company.
Hmm.
But obviously, a Wyoming company can't just process global gambling transactions. So they partnered with a marketing and payment processing firm registered in Cyprus.
Cyprus, which makes
Yeah.
total sense because Cyprus is heavily integrated into the European banking system.
Exactly.
That allows them to establish merchant accounts and process transactions globally, which is something a U.S. bank would likely flag and shut down instantly for offshore gaming.
Precisely. Cyprus provides the financial gateway. But here's a kicker. Neither Wyoming nor Cyprus is actually holding the gaming license.
Wait, really? Then who holds it?
The actual authorization to conduct gaming operations comes from the government of the autonomous island of Anjouan.
Condivan.
Yes, in the Union of Comoros.
Okay, so a tiny island nation off the coast of Africa.
Yes. Anjouan has positioned itself as a rapid, cost-effective jurisdiction for offshore gaming licenses. It provides the legal cover to state, hey, we are a licensed gaming entity.
Wow.
And finally, the actual license holder on paper is a company registered in Belize, which is another jurisdiction known for strict corporate secrecy laws.
So they've just spread this across the globe.
Right. By distributing their operations, payment processing, and licensing across Wyoming, Cyprus, Comoros, and Belize, they create this decentralized legal framework. It allows them to accept payments from a global user base while insulating the core operators from direct, single jurisdiction regulatory crackdowns.
It's an engineered liability shield. That's
Yeah.
crazy. But let's look at why this geographic friction even exists in the first place. Todd, the founder, spends a lot of time in that pitch meeting leaning into this idea of offline friction.
He really hammers that point.
He does. He points out that for the vast majority of the world, playing the lottery is an inherently local, physical act. You walk to the corner store, you buy your coffee, and you buy a ticket with cash.
Because the infrastructure of state-sponsored lotteries was built around national, or in the U.S., state borders. They were designed specifically to raise funds for local municipalities, schools, roads, veteran services.
Right.
Because they're fundamentally tax collection mechanisms tied to local governments, they are geographically locked by design. If you are in Spain, you don't drive to France to play the French lottery.
Well, Todd brings up a brilliant anomaly to highlight exactly this. He points out that Las Vegas is the undisputed gambling capital of the United States.
Yeah, you can bet on virtually anything there.
Anything. Yet lotteries are completely illegal in Nevada.
Yep.
So if a resident of Las Vegas wants to play the Powerball when the jackpot hits $1 billion, they literally have to get in their car, drive across the state border into California or Arizona, stand in line at a gas station, and buy a paper ticket.
That is the textbook definition of geographic friction.
Nowhere.
The product is physically inaccessible to the consumer, despite massive demand. Now, extrapolate that Nevada problem to the entire globe. If you are sitting in Argentina or Japan or South Africa, you have absolutely zero access to the U.S. Powerball. You are permanently locked out of the market.
And this brings us to the core psychological engine of PlayLottoGlobal's entire business model, the gravitational pull of the United States super jackpots.
It's a huge pull.
Todd delivers a vital statistic to Jeffrey in the transcript. He notes that in a recent 3-year period, there have been $32 billion jackpots in the United States. 32.
That's wild.
But for the rest of the entire planet combined, 0.
That disparity right there is the entire foundation of their global strategy. The rest of the world has local lotteries, sure. I mean, a Brazilian player might win a few million real in the Mega Sena, but the U.S. lotteries have mutated into these global financial spectacles.
They really have. They're basically creating a digital wormhole because they aren't inventing a new game. They are building a digital courier service. It allows someone in Buenos Aires to basically reach their hand through the internet straight into a Florida public supermarket and buy a Powerball ticket. But I have to ask, why are the U.S. jackpots so consistently massive compared to the rest of the world?
Well, it is entirely by design. Todd explains the game theory behind this in the pitch. He tells the story of Mega Millions, which is the primary competitor to Powerball in the U.S. Recently, Mega Millions fundamentally altered their economic model. They raised the price of a single ticket from $2 to $5.
Right, and Todd notes that the public immediately complained about the price hike.
Oh, of course they did. People hate price hikes.
Yeah.
But the organizers justified it with simple math. By charging $5 a ticket, they can guarantee that the starting jackpots are exponentially higher and that they roll over into the billions much faster. They realized a crucial shift in consumer psychology. The modern consumer isn't motivated by a slightly better statistical probability of winning $1 million. They are motivated by the astronomical, life-altering size of the top prize.
They are manipulating the expected value equation.
Yes, exactly.
People aren't paying $5 for a piece of paper. They are paying for the hope of a payout that defies human comprehension. Todd literally compares it to buying a Starbucks coffee. He says a $5 lottery ticket is the same price as a fancy coffee, but a latte doesn't give you the psychological thrill of potentially waking up a billionaire the next morning.
Hope is the actual commodity being sold. The paper ticket is just the receipt. And this is where PLG's total addressable market comes into sharp focus. Todd states that there are roughly 5.8 billion people online globally. He estimates about 5.5 billion of them are eligible, non-U.S. citizens who can technically transact online.
That's a massive number.
Huge. PlayLottoGlobal is making a massive calculated bet. If an American is willing to pay $5 for the hope of a billion-dollar payout, someone in Brazil or India or the UK will absolutely want access to that exact same hope.
But hold on, let's unpack that. 5.5 billion is just the number of people with an internet connection. If you factor in global banking access, varying gambling ages, and local ISP bans on offshore betting, their actual actionable market has to be a fraction of that.
Oh, sure.
It feels like Todd is really inflating his total addressable market for the Wall Street pitch.
He is undoubtedly painting the largest possible target for the investor. I mean, that's what you do in a pitch. The 5.5 billion figure represents the theoretical maximum limit of global awareness, not the immediate purchasing base. But think about it. Even if the actionable market is only 10% of that.
So 550 million people.
Right. It is still a market size that dwarfs the entire domestic U.S. population. They are looking at a massive, pent-up global demand for American-sized jackpots that has historically been starved of supply purely due to geography.
Okay, so we've established the product. Borderless, frictionless access to massive, localized jackpots. But having a regulatory shield and a theoretical market of billions doesn't magically bring customers to your website.
No, it doesn't.
If you are a startup and you try to run traditional digital advertising like Google Ads, Facebook campaigns to acquire customers globally across dozens of languages for a highly competitive gambling product, your customer acquisition cost, your CAC, will bankrupt you in a week.
Almost instantly.
Which brings us to the customer acquisition strategy. How do they actually get people to the platform?
This is where PLG pivots away from traditional advertising entirely. They rely on a decentralized, virtually zero-cost affiliate network powered exclusively by QR codes and digital links.
Let's look at the actual mechanics of this, because it is deceptively simple but incredibly aggressive. According to the transcript, any person on Earth can sign up to be a PLG affiliate for free.
Totally free.
You get a unique QR code. If you share that code and someone scans it and buys a ticket, you get a direct 10% commission on every dollar they spend.
And crucially, that is a recurring commission.
Okay, explain that.
If a user signs up and purchases, say, a $10 monthly subscription to automatically play the Powerball every week, the affiliate receives 10% of that transaction every single month, in perpetuity, for as long as that user remains active.
Wow. But the real depth of this system is the tiered royalty structure. Todd uses a very specific, vivid hypothetical in the meeting to explain this to Jeffrey. He creates this persona of the broke waitress in Brazil.
It's a great example.
It is. He sets the macroeconomic stage by noting that Brazil is a massive country with severe income inequality, stating that 40% of Brazilians make less than $300 a month. So he introduces this hypothetical waitress who is grinding out a living on $200 a month.
It is a highly strategic narrative device. Todd is grounding abstract financial math into a relatable human narrative, to show Jeffrey the psychological leverage they possess in emerging markets.
Right. So this waitress gets her free PLG QR code. She hasn't spent a single penny of her own money. She shares this code on her social media, WhatsApp groups, wherever. Let's say she gets enough people playing under her code that she earns $500 in commissions. Todd then highlights the power of currency arbitrage.
The exchange rate.
Exactly. At the time of this pitch, the conversion rate is roughly 6 to 1. So her 500 US dollars instantly becomes 3,000 Brazilian real.
Which fundamentally alters her socioeconomic reality. She was making $200 a month waiting tables, and suddenly she has a passive income stream that completely eclipses her primary wages.
Yeah.
But, the geographic borderlessness of the internet is what makes this truly explosive.
Exactly. Because her code is living on the internet, she isn't restricted to marketing to other Brazilians. Todd explains that a person in Japan or Germany could stumble onto her social media, scan her QR code, and start playing the U.S. Powerball.
Right.
She is now earning a commission on someone playing a U.S. lottery from halfway across the world, paid out in U.S. dollars, which is then converted into Brazilian real, and deposited directly into her wallet.
And if the people who sign up under her also decide to become affiliates and generate their own codes, she earns a second-tier royalty on all of their sales as well.
It just cascades.
It does. Now, you have to contrast this with traditional multi-level marketing, or MLMs, which Howard, the president of PLG, explicitly does during the pitch.
Yeah, Howard is very quick to differentiate them. He points out that in a traditional MLM, you have to buy a massive starter kit. You have to buy $500 worth of inventory, store it in your garage, and then host these awkward parties to convince your friends and family to buy proprietary vitamins or kitchenware they don't actually need.
The fundamental friction in almost all affiliate and MLM marketing is education. You have to educate the consumer.
Right.
If you are selling a new health supplement, you have to explain the scientific benefits, the ingredients, why it is superior to a generic brand.
Right.
You have to actively pitch the product. But Todd points out a profound truth about the lottery. 99% of the world already knows the word lotto.
Yes. Todd emphasizes this repeatedly. We don't have to explain what it is. You don't have to explain blockchain technology to them. You don't have to convince them to change their skincare routine. You just put the word lotto and a QR code in front of them. The desire, the hope for a massive payout is already deeply ingrained in global culture.
By entirely removing the educational barrier, the friction of the sale drops to near absolute zero. It is an impulse click.
It's less like traditional sales and more like setting digital lobster traps. You don't have to convince the lobster to like the bait. The lobster already inherently desires the bait. You just drop your QR code trap into the digital ocean, go to sleep, and check what you caught the next morning.
That's a great way to put it.
But let's look at the reality of affiliate networks. What happens when the market hits saturation? If everyone in Brazil is suddenly a PLG affiliate pushing their own code, the effectiveness of the individual trap dilutes to zero.
Saturation is definitely the terminal illness of all affiliate models. However, Todd and Jeffrey discuss a technological bypass to this human limitation: artificial intelligence and automated bot deployment.
Right. Jeffrey brings up that AI can instantly translate their marketing materials into any language, localized perfectly. But Todd takes it into a much more aggressive territory. He talks about deploying bots.
Todd describes using AI bots to actively scour the internet, indexing social media platforms in real time. The bot's prime directive is incredibly simple. Find a user who is engaged with the concept of the lottery. Perhaps they tweeted the word lotto or complained about not winning the Mega Millions, and autonomously present them with the QR code.
Unbelievable.
And Todd casually mentions a friend's tech company that expects to deploy 200 to 300 million bots capable of conducting these microtransactions and interactions.
Okay, let's pause there, because from a technical standpoint, that sounds like a massive exaggeration. Deploying 300 million autonomous bots on platforms like X or Meta without triggering massive API rate limits, spam filters, and immediate IT bans is practically impossible in today's security environment.
It would be incredibly difficult.
Yeah, I feel like Todd might be selling Jeffrey a science fiction concept just to inflate the tech valuation in the room.
It is highly likely that the 300 million bots figure is pitch room hyperbole. Founders do that. However, the underlying strategy is sound. Even if they deploy a fraction of that number, say, highly targeted, algorithmically driven ad tech that behaves like bots, the goal remains the same: automate the distribution of the QR codes at a scale human affiliates could never reach.
And think about how this gamifies the affiliate's psychology. Todd describes the daily user experience. An affiliate wakes up, pours a cup of coffee, and opens their beautiful back-office dashboard on their phone. What do they see?
They see real-time activity.
Yes, they see anonymous strangers from Germany, Japan, and India who have played the lottery under their code while they were sleeping.
They see money manifesting in their digital wallet. It fundamentally gamifies the affiliate experience just as much as it gamifies the lottery itself. The affiliate is playing a game of algorithmic spread, seeing how far their code can propagate across the internet, while the end user is playing a game of statistical chance, hoping for a jackpot.
Wow, yeah, both are chasing a payout.
Exactly. But the affiliate's payout is mathematically superior because it relies on sheer volume, not luck.
So the marketing engine is virtually free, decentralized, and driven by a combination of gamified human greed and automated AI deployment. But what are the actual economics behind the platform? I mean, when someone actually scans that code, downloads the app, and buys a ticket, how does selling a single digital product translate to the billions in revenue Todd is projecting?
To understand the machine, we have to meticulously dissect the financial projections document provided in the sources. The unit economics of PLG are entirely dependent on massive scale applied to microtransactions.
Right.
The barrier to entry for the consumer is kept intentionally almost comically low.
Yeah, looking at their financial models, they are targeting an incredibly low average user spend. They are modeling for just $10 a month per customer. That is essentially buying 2 Mega Millions tickets over a 30-day period. It's pocket change, even in many emerging economies.
But observe what happens to the math when you apply global scale to that $10 spend. The document outlines several growth scenarios. Let's examine what they call Scenario C.
Okay, Scenario C.
In this scenario, they project acquiring 1 million active customers. At $10 a month, that generates $10 million in gross revenue monthly, which translates to $120 million in annual gross revenue.
$120 million a year from people spending pocket change. But here is the part of the projection document that I find absolutely unbelievable. Their fixed operating costs. For year one, they estimate their fixed costs to be approximately $55,000 a month. That is roughly $660,000 a year to run a platform generating $120 million in volume.
I know, it sounds crazy, but it illustrates the theoretical magic of a purely digital, zero-inventory business model.
How so?
If a traditional retail corporation, say a clothing brand, wants to scale from 100,000 customers to 1 million customers, their capital expenditures explode. They have to build physical factories, lease massive distribution warehouses, hire thousands of logistics personnel, and manage infinitely complex supply chains.
Right. The real world is expensive.
Exactly. Their fixed costs skyrocket in tandem with their revenue. PLG, conversely, has no physical inventory. They do not print paper tickets. They do not ship physical goods.
Okay, that makes sense in a vacuum. But let's look at the actual reality of operating a high-volume global platform. $660,000 a year. That is absurd.
You don't buy it.
Not at all. 1 million active users processing microtransactions globally means dealing with massive payment gateway fees. Merchant accounts for offshore, cross-border gambling are considered extremely high risk. Banks charge 5 to 8% per transaction, plus rolling reserves.
That's true. The banking fees are steep.
And furthermore, the customer support infrastructure required to handle 1 million users dealing with lost passwords, failed payments, and withdrawal requests would burn through $660,000 in a single quarter.
Your skepticism is entirely warranted. The fixed cost projections are almost certainly aggressive, idealized numbers engineered for a Wall Street pitch deck. They are presenting a scenario of perfect operational efficiency.
Right.
However, even if their fixed costs are off by a factor of let's say it actually costs $3 million a year to run, the operating leverage remains astronomical. Adding 9 million new users doesn't require building a new factory. It simply requires spinning up more server capacity on AWS and hiring more offshore customer support.
That's fair. The scalability is still there. But let's talk about the margins on the tickets themselves, because that is where the real money is made. The document gives the example of a standard US Powerball ticket. On the PLG platform, the consumer pays roughly $6 for that ticket. The cost to PLG to procure and process that underlying ticket is about $2.20. That yields a gross margin of over $3 per ticket. It's pure recurring profit on a frictionless digital transaction. But there is a specific financial mechanism they introduce in the pitch that completely shifts the paradigm of the entire business. They call it fractional ticketing.
Yes. Fractional ticketing is undeniably the most innovative, aggressive, and potentially lucrative financial mechanism they are deploying. It moves PLG from being a simple digital courier to acting as a sophisticated financial derivative market.
This is where the mechanics are actually wild. They are taking a product that is already a microtransaction, a $6 lottery ticket, and atomizing it into even smaller pieces.
Right.
Todd uses the example of a billion-dollar U.S. jackpot. For a vast portion of the global population, a $6 U.S. ticket is simply too expensive due to harsh currency exchange rates. So, PLG will sell you a 5% participation in a single ticket for just 30 cents.
The underlying math here is vital to their profit margins. The consumer pays 30 cents. If that specific ticket wins the billion-dollar jackpot, the consumer receives their 5% share, which equates to $50 million.
$50 million for 30 cents. It's brilliant from a consumer psychology standpoint. The consumer gets a very real mathematical chance at a life-altering amount of money for literally the loose change in their digital wallet.
It's irresistible.
But look at it from PLG's side. It's like taking a single slice of pie, cutting it into 20 microscopic slivers, selling each sliver for pennies, and ending up making 4 times the total revenue you would have made if you just sold the whole slice. PLG achieves an estimated 400% profit margin on a single ticket by fractionalizing it.
But we must ask how they actually execute this mechanically. Are they physically buying the underlying ticket and holding it in a vault, acting as a custodian for the 20 people who bought fractions? Or are they operating a synthetic derivative market where they don't actually buy the ticket, but simply agree to pay out the fraction if the numbers hit?
If it's a synthetic derivative, that introduces massive counterparty risk. If the numbers hit and they didn't actually buy the ticket, PLG is suddenly on the hook for $50 million they don't have.
Exactly. Assuming they're mitigating that risk, they must be purchasing the underlying asset. But the way Jeffrey, the investor, interprets this is fascinating.
Yeah, tell me about that.
Jeffrey comes from the highly leveraged world of Forex foreign exchange trading. When Todd explains fractional ticketing, Jeffrey immediately maps it onto his own financial worldview. He compares fractional ticketing to Forex leverage.
Right. Jeffrey gets incredibly animated in the transcript. He says, when people deposit $300, they get leverage, and Wall Street gives them leverage money, and they can win even more. He compares the lottery explicitly to his own proprietary trading system, which he calls the Pakwan Code.
We need to explain how Forex leverage works. To understand Jeffrey's analogy here. In foreign exchange trading, currencies move in microscopic fractions of a cent. To make any real money, you need massive capital.
Yeah.
So brokers offer leverage. You put down $300, and the broker effectively lends you $30,000 to trade with.
Right.
It amplifies your buying power, allowing you to capture massive gains from tiny market movements. Jeffrey sees the lottery not as a game of chance, but as a high-volume global trading floor, where the commodity being traded is asymmetric risk.
But Todd is very quick to correct Jeffrey on a crucial distinction between Forex leverage and fractional ticketing. Because in Forex trading, leverage is a double-edged sword. If you use massive leverage and the currency moves against you, you don't just lose your $300 deposit, you can actually owe the broker thousands of dollars. You take on infinite downside risk.
Precisely. Todd points out that with a fractional lottery ticket, there is zero additional risk to the consumer. You spend your 30 cents. The absolute worst-case scenario, the maximum downside, is that you lose exactly 30 cents.
You don't owe anyone anything.
No. You do not owe the platform a margin call. The risk is strictly capped, while the upside remains in the tens of millions.
Which makes this an incredibly powerful tool for global market penetration. 30 cents is negligible in the United States. You wouldn't bend over to pick up 30 cents on the sidewalk. But in emerging economies, 30 cents is a highly accessible price point.
It opens up the entire world.
It does. It democratizes access to what is essentially a global cultural event, the billion-dollar Powerball draw. It allows anyone, regardless of their local economic conditions, to participate in the collective hope of a super jackpot while simultaneously driving PLG's profit margins into the stratosphere.
So if we synthesize all of this, PLG has an incredibly lucrative model on paper. Astronomical margins driven by fractionalization, a decentralized marketing engine with near zero customer acquisition cost, and a universally understood product.
It sounds perfect.
But furthermore, Todd states during the pitch that the business is already live and functioning. If the machine is already built and the fixed costs are as low as they claim, why is Todd taking meetings to raise money? Why does he need Jeffrey?
This brings us to the actual negotiation, the psychological chess match between Todd and Jeffrey over the capital strategy. Todd states very clearly at the beginning of the call that he is a Wall Street guy. He says he has been raising money for companies for 30 years. He inherently understands that traditional venture capital comes with a massive penalty for founders.
Dilution.
Dilution is the silent killer of founder wealth. In a standard VC round, an investor gives you cash in exchange for equity, a percentage of ownership. If the company is successful and needs to raise more money later to scale, they issue more shares. The original founders and early investors get diluted. Their slice of the pie shrinks as the valuation grows.
Right.
Todd is structuring this deal specifically to avoid traditional venture capital pitfalls. Todd explains that he is raising what he calls a final profit-sharing member offering. He is only offering 40 units in total at $25,000 per unit. So the total raise is a relatively minuscule $1 million.
Which is nothing for a global platform.
Nothing, but the actual structure of this instrument is fascinating. It is a 2-year convertible loan note that pays an 8% interest rate.
Let's deconstruct the mechanics of that convertible note, because it is brilliantly designed to eliminate investor friction. Todd is essentially saying to Jeffrey, I am not asking you to buy equity right now. I am asking you for a loan. I will pay you an 8% annual yield just to hold your money for 2 years.
Pretty sweet deal.
But the interest rate is just the appetizer. The real hook is the conversion rate.
Right. Todd guarantees the investor the right to convert that debt into equity, to become a permanent member of the LLC at a fixed valuation from a year ago, which he states was $30 million.
And he places massive emphasis on the fact that this valuation is locked in regardless of how successful the platform becomes over the next 24 months. Standard convertible notes often convert at a discount to the next funding round, meaning the investor still pays a premium if the company explodes in value.
But Todd isn't doing that.
No, Todd is offering Jeffrey a fixed retrospective price.
But this isn't standard venture capital. If you strip away the marketing speak, this is essentially a bribe disguised as a debt instrument. Todd pitches Jeffrey an almost utopian zero-risk scenario. He says, imagine you buy 2 units for $50,000. I pay you your 8% interest. Then I give you your $50,000 back in principal.
Okay.
At that moment, your cost basis is zero. You have $0 at risk. Yet you still hold the right to convert and become an LLC member. And as a member, you get a pro rata share of the quarterly profits forever.
It is the holy grail of investment pitches. Zero cost basis, zero dilution, capped downside, and infinite upside through perpetual quarterly profit distributions. It is an incredibly aggressive FOMO tactic fear of missing out engineered specifically for a financially literate investor.
It really is.
But we must look deeper at the subtext of this meeting. Why is Todd offering this sweetheart, seemingly too good to be true deal to Jeffrey specifically? Todd is an experienced Wall Street operator. He doesn't give away permanent profit shares for a measly $50,000 loan unless he is buying something far more valuable than cash.
Exactly. Who is Jeffrey, really? Because throughout the raw transcript, Jeffrey casually drops hints about his true value. He isn't just a guy with a checkbook. He mentions owning a global satellite agency capable of driving massive online traffic.
Yep.
He talks about his vast Forex trading networks. He casually mentions having deep direct access to the Hearst broadcasting network, which he refers to as the #1 broadcaster in Europe.
And perhaps most tellingly, he brings up his business partner, Denise Burkhardt. Jeffrey casually states that she was the rainmaker for a $13.5 billion private money buyout attempt of Paramount, actively working against David Ellison's bid.
Wow.
Jeffrey is a nexus. He is a central node connecting global media distribution, massive financial liquidity, and high-level corporate deal-making.
So Todd doesn't want Jeffrey's $50,000. He wants to graft PLG onto Jeffrey's networks. Todd explicitly positions this pitch not as a desperate founder pleading for seed capital, but as a velvet rope invitation to an exclusive club. He literally tells Jeffrey, if you're an affiliate marketer and you don't work with us, you're just kind of stupid because it's free.
It's a stunning display of calculated arrogance. I mean, you do not typically call a multimillionaire investor stupid during a pitch.
Definitely not.
Todd is actively flipping the traditional power dynamic of capital raising. He isn't pitching PLG to Jeffrey. He is pitching Jeffrey on Jeffrey's own latent, untapped power to monetize his existing audience.
Let's look at the specific math Todd uses to seduce him. Todd pivots from the $50,000 loan to the affiliate model. He says, Jeffrey, with your satellite agencies, your Forex lists, your broadcasting networks, do you think you could bring in 10 million users to our platform in a year?
And Jeffrey, without hesitation, says, that's very easy.
Very easy. So Todd walks him through the implications of that easy task. If Jeffrey brings in 10 million users and they spend the projected minimum of $10 a month, That generates $1.2 billion in annual volume, flowing directly under Jeffrey's specific affiliate commitment.
That's massive.
And because Jeffrey receives a 10% top-line commission, that means Jeffrey would personally earn $120 million a year.
$120 million a year in completely passive income, just for blasting a QR code across his existing satellite network. And that doesn't even factor in the second-tier royalties if his network starts sharing the code themselves.
The $50,000 convertible note is a Trojan horse. It is a psychological anchoring device to get Jeffrey invested in the ecosystem. The actual transaction taking place in this meeting is Todd securing a multi-billion-dollar distribution pipeline for the cost of an 8% interest payment on a microloan.
It's brilliant negotiation. Todd is basically saying, I'll pay you to hold your money, I'll give you equity for free, and by the way, I've built a digital machine that will allow you to extract $100 million a year from the assets you already own.
Right.
No wonder Jeffrey responds by saying, I love it, man. This is the easiest marketing strategy I've ever heard.
However, we still have to reconcile the fact that Todd is actually raising the $1 million. Even if the primary goal is securing Jeffrey's network, Todd still needs that cash from the 40 loan notes right now.
True.
When Jeffrey asks about the use of proceeds, like, where exactly is this $1 million going? Todd's answer reveals the final, most audacious layer of PLG's global growth strategy.
Todd states very clearly that the money is not going towards server costs or payroll or Facebook ads. The entire $1 million is earmarked to fund a newly created events division.
They are targeting the physical world to fuel their digital machine. Todd lists out his specific sponsorship targets: the Olympics, the World Cup, Formula One racing, and the UFC. He is targeting the highest viewership, most globally synchronized moments in human culture.
Todd dropped specific metrics during the pitch to justify this. He notes that Formula One has 360 million viewers tuning in every 2 weeks, and he emphasizes a critical point. Formula One is now a publicly traded company on Wall Street, having been sold by its founder.
And Jeffrey immediately chimes in on that. He notes he follows F1 closely and mentions his daughter actually befriended Lewis Hamilton.
Right. And then Todd also targets the UFC, noting that under Dana White's leadership, the UFC has amassed 850 million followers globally. Crucially for PLG, Todd notes that 78% of those UFC followers are non-American.
That's huge.
This demographic aligns perfectly with PLG's target market of non-U.S. citizens hungry for access to American lotteries.
But how does sponsoring a physical sporting event actually work for a purely digital lottery platform? Normally, a brand, say, a beer company, pays tens of millions of dollars to put their logo on a banner at a race. The race happens, the cars drive by, the fans see the logo, maybe brand awareness increases slightly, and then the race is over. The advertising spend evaporates the moment the broadcast ends.
That is the traditional linear advertising model. PLG's approach introduces what Todd calls perpetual revenue. They aren't just buying a billboard. They intend to place their unique QR codes on the physical banners around the track, on the digital TV screens broadcasting to those 360 million F1 viewers, and printed directly on the physical tickets the fans hold in the stands.
Okay, let's track the mechanics of that. A fan sitting in the stands at the Monaco Grand Prix sees the banner, pulls out their phone, and scans the QR code. They are taken to the PLG site, they download the app, and they buy a $5 Powerball ticket. That's a standard conversion.
Right.
But then the race ends. The fan flies home to Germany or Japan or Brazil. They go back to their daily life.
But they still have the app on their phone. And because the initial acquisition was tied to that specific QR code scanned at the race, the digital infrastructure tracks that user in perpetuity.
This is where the technological mechanism is vital. How do they track a fan 5 years later back to a specific UFC fight? They must be using hard-coded affiliate IDs embedded directly into the app download package, or lifetime persistent cookies on the web platform.
Exactly. The initial scan permanently anchors the user's digital wallet to the event's affiliate branch. Therefore, when that fan buys a lottery ticket 6 months later from their couch in Munich, PLG still registers that transaction as originating from the Monaco Grand Prix sponsorship.
By sponsoring these globally broadcast events, PLG is turning fleeting cultural moments into permanent digital distribution nodes. The physical event ends, but the revenue stream from the fans who acquired the code continues forever. You sponsor an event once, and you get paid every time a fan buys a Powerball ticket for the rest of their life.
But Todd takes this concept of perpetual revenue and uses it as a weaponized negotiation tactic against the event organizers themselves. He uses the UFC as his prime example. He outlines his strategic plan to fly to Vegas and sit down with Dana White.
Oh, this part is brilliant.
He plans to ask Dana a very direct question. How much does Monster Energy, which is the main sponsor plastered in the center of the octagon, actually pay the UFC?
Todd notes that Monster gives the UFC cash upfront and provides brand credibility, but they do not pay commissions. If a fan watches a fight and goes to a gas station to buy a Monster Energy drink, the UFC doesn't see a dime of that retail transaction.
This is where Todd flips the script. He wants to offer the UFC an upfront sponsorship fee, just like Monster, but also assign the UFC their own dedicated master affiliate code. This means the UFC Corporation itself would earn the 10% recurring commission on every single transaction generated by any fan who scanned the code during the broadcast.
Todd is essentially walking into Dana White's office and saying, I won't just sponsor your event for a flat fee. I will turn your 850 million global fans into a recurring $100 million annual revenue stream that feeds directly into your corporate balance sheet forever.
And the corporate implications of this are staggering. Both Formula One and the UFC's parent company, TKO Group, are publicly traded entities. Todd poses a rhetorical question to Jeffrey. What happens to a public company's valuation on Wall Street if they suddenly add $120 million of pure zero-cost net income to their bottom line?
Jeffrey, being a Wall Street guy himself, instantly understands the math. Public markets value companies based on multiples of their earnings. If you add $100 million of pure profit and the market applies a 15x multiple, you have just increased the market capitalization of that sports franchise by $1.5 billion overnight.
PLG is positioning itself not merely as a consumer app for buying lottery tickets, but as a B2B valuation multiplier for global sports franchises.
Yeah.
They're offering to inject hundreds of millions of dollars of passive income directly into the balance sheets of the world's biggest sports leagues, fundamentally altering their stock prices.
And as the final layer of this corporate strategy, they weave in a massive charity angle to create an impenetrable shield of corporate goodwill. During the pitch, they discuss making something called the Cinco Foundation a preferred charity on the platform.
When Jeffrey mentions that he is deeply involved in charitable foundation projects, Todd immediately integrates it into the model. He notes that PIG will automate donations to the Cinco Foundation every month based on platform volume, which can then be distributed to support Jeffrey's specific charities.
And when Jeffrey brings up his daughter's connection to Lewis Hamilton, Todd doesn't miss a beat. He instantly pivots to how PLG could support Hamilton's personal foundation. He pitches the idea of helping 50 million of Hamilton's fans earn free money through the affiliate code, while a percentage of the global volume automatically funds Hamilton's charitable goals.
It creates a narrative where massive profit extraction is masked by automated, large-scale philanthropy.
It is a holistic, incredibly aggressive, and tightly integrated strategy. When you view the entire architecture from a macro perspective, they are synthesizing the emotional, irrational draw of billionaire maker jackpots, the frictionless, zero-cost distribution of QR codes, the highly gamified psychology of multi-tier affiliate marketing, and the massive synchronized scale of global sports broadcasting.
All of it.
And they are wrapping all of these consumer mechanics inside financial structure, convertible debt, and fractional derivatives, designed specifically to appeal to high-net-worth Wall Street liquidity providers.
It really is breathtaking when you look at all the pieces operating together. PlayLottoGlobal is attempting to take a $380 billion, highly fragmented, structurally inefficient analog habit, the act of walking to a store with physical cash to buy a paper ticket, and forcefully drag it into the digital age.
Yeah.
They are bypassing local regulations through offshore corporate hopscotch. They are taking a $6 product and slicing it into 30-cent synthetic microtransactions.
Yeah.
And they are attempting to distribute this hope using an army of broke waitresses, automated AI bots, and the center of the UFC octagon.
And whether you personally ever intend to play the lottery or not, studying the structural model is a masterclass in modern digital scalability. It perfectly illustrates how the intersection of borderless digital payments, decentralized affiliate psychology, and global networks averaging can theoretically engineer a zero-inventory startup into a billion-dollar revenue engine while claiming fixed operating costs of less than $1 million.
It is the ultimate manifestation of digital leverage.
Which brings us back to our starting point. We used to think of a product as a physical object, something you hold, something you manufacture, something you buy once. But in this model, the actual product is hope. And the distribution network is not a fleet of delivery trucks. The distribution network is literally every single human being holding a smartphone.
The friction of commerce has been entirely removed, replaced by algorithmic distribution.
So I want to leave you with a final thought to mull over, one that extends far beyond the lottery industry. If a simple, free QR code can turn a waitress in Brazil into a global distributor of American financial derivatives, and a single sports sponsorship can turn a live broadcast into a permanent lifetime revenue stream, what happens to the fundamental concept of work in the digital age?
Big question.
What happens when every single interaction we have online, every link we share in a group chat, every post we make on social media is secretly embedded with a lifetime multi-tiered commission structure?
Yeah.
Are we moving toward an economy where human connection is entirely monetized and we are all destined to become nothing more than walking, talking billboards for someone else's super jackpot?
It represents a profound shift in how we quantify and monetize human interaction on a global scale.
Something to think about the next time you casually scan a code. Thanks for joining us on this deep dive. See you next time.